You know, usually when we talk about cooking a big family recipe, there's this expectation of comfort.
Right, exactly. A sense of routine.
Yeah. You have the faded recipe card, you go to the grocery store, and you know exactly what you need.
You've done it 100 times.
But imagine you walk into the store to get the ingredients for that famous family cake, and suddenly the butter is twice the price.
Oh, yeah. That's a shock.
And the flour is just mysteriously out of stock. And the eggs are so expensive, you start doing mental math right there in the baking aisle.
Yeah, just to see if this cake is actually worth making anymore.
Exactly. It goes from this act of love to like a strict return on investment calculation. You're suddenly acting like a supply chain manager just to pick a cake.
Well, that mental math you're doing in the aisle, that's the exact same calculus happening in corporate boardrooms across the consumer packaged goods sector right now.
Oh, for sure.
The difference is when they miscalculate the cost of the butter and the eggs, it doesn't just ruin dessert. It wipes out billions of dollars in shareholder value.
Which brings us perfectly to the reality of the situation today. Welcome back to Talk Tickers, by the way, where we do a deep dive into corporate earnings calls for you, the retail investor.
That's right.
And that exact scenario, trying to serve up something familiar while the cost of, every single ingredient and piece of packaging goes haywire, is playing out at massive scale for Campbell's company.
It really is.
So today we are tearing into the Campbell's Q3 2026 earnings call transcript. Our objective here is pretty straightforward.
We want to cut through the noise.
Exactly. We're cutting through management's exceptionally skilled corporate speak to figure out if this company is still, a safe, defensive dividend play.
Or if rising ingredient costs and broken supply chains have turned it into a margin-crushed value trap.
Right. Because for a retail investor holding the stock or maybe eyeing it for a dividend portfolio, you need to know what's actually happening beneath the hood.
You need the actionable data.
So let's look at the headline numbers first. Because that's where Wall Street starts, right?
Yeah, the headline data is exactly where the Wall Street algorithms place their first bets.
And looking at the initial release for Q3, management made sure to highlight a very specific, very round number.
They absolutely did. Their snacks division margins hit 10%.
10%. I noticed that. And, if you're just skimming the press release on your phone, 10% sounds like a really solid recovery.
Oh, it sounds great on paper.
They made sure to contextualize it too. They called it a sequential improvement from the 7% margin they posted in Q2.
Right, going from 7 to 10?
Yeah, so on the surface, the narrative they're trying to feed the market is, hey, we identified the problem in Q2, we intervened, and we are on the upswing.
But taking a victory lap on a sequential margin improvement in a highly seasonal business, that feels incredibly misleading.
It does. Why is that such a bad metric to focus on?
Well, it's kind of the oldest trick in the investor relations playbook.
Oh.
Yeah. Highlighting quarter-over-quarter growth in a business that fluctuates wildly based on holidays and promotional cycles is essentially just noise.
That makes sense. So what should we be looking at?
The reality check comes when you look at the year-over-year data.
Okay.
When you compare this Q3 to Q3 of last year, those snacks margins are actually down 400 basis points.
Oh, 400.
Yes.
That is 4 full percentage points of profit margin completely evaporated from their most critical division.
It's massive.
As an investor, that is alarming. In the CPG business, consumer packaged goods, you're dealing with pennies on the dollar.
Exactly, spread across millions of units.
Right. Millions of bags of Goldfish crackers and mulatto cookies.
Yeah.
So losing 400 basis points of margin means the core profitability engine of that division has fundamentally degraded.
Just broken.
How does a company of this scale physically lose that much margin in 12 months?
Well, it's a combination of unabsorbed fixed costs and raw input inflation. But the really scary part, it isn't just isolated to the snacks division.
Really?
Yeah, that is the real red flag here. If you look broader, the organic gross margin for the entire company was down 240 basis points in Q3.
240 company-wide.
Yep. This indicates broad-based systemic pressure across their entire portfolio.
So they're just making significantly less money on the exact same items they were selling a year ago.
Exactly. The cost to produce a can of soup or a bag of chips has risen, but their ability to pass that cost onto the consumer has hit a brick wall.
Wow. Okay, so if Campbell's is actively bleeding 240 basis points on the gross line company-wide, the immediate question for anyone holding the stock is, do they have a realistic forecast to fix this next quarter?
And the short answer is no.
Yeah, because when you look at their Q4 guidance, management isn't exactly projecting a sunny turnaround.
Not at all.
They guided net sales to the lower end of their -1% to -2% range.
So their top line is actively shrinking.
Right. And their EPS earnings per share is projected to come in at $2.20, or possibly even below that.
But, the EPS guidance is where the transcript gets incredibly muddy.
Yeah, I wanted to ask you about this.
Yeah.
Because they're actively acquiring companies right now, right?
Yes. Specifically, the La Regina acquisition.
Okay, let's break that down.
This is a massive piece of the EPS puzzle, but it requires translating some dense GAAP rules.
Generally accepted accounting principles.
Exactly. So the transcript reveals that Campbell's executed a partial acquisition of La Regina.
And what do?
They're an Italian agricultural company. They bring highly profitable tomato and sauce processing capabilities into the Campbell's fold.
Oh, I see.
Strategically, this is designed to vertically integrate and support their Rouse brand, which is honestly their crown jewel premium asset right now.
Right. Rouse is huge. And the transcript noted this acquisition actually brings an estimated 70 to 80 basis point margin benefit to the operational side.
It's highly accretive.
Yeah. They bought a high margin asset. They are vertically integrating their tomato supply for a premium pasta sauce. That should be a massive win for the bottom line.
You would think so.
But if it's margin accretive, why is the EPS projection still so incredibly cautious? I'm looking at this math and thinking, if you buy a business that boosts your margins by 80 basis points, your per share earnings should reflect that strength.
It should.
So how does buying a high margin business make the EPS look weak?
Well, it's because of the specific DAF mechanics regarding partial acquisitions and minority interest.
Okay, walk me through that.
When a corporation like Campbell's buys a controlling stake in a company, but not 100% of it, they consolidate the financials.
Right.
But they're also forced to account for the minority shareholders. So in this specific deal structure, the GAAP rules dictate that Campbell's must include about 7 million new shares into their total diluted share count calculation for the year.
Oh, wow. So they have to add shares.
Exactly. This artificially inflates their total share count to 306 million shares.
So it's a share dilution issue.
Yeah.
They improved the total net income of the business by bringing in La Regina's high margin operations, but they are suddenly dividing that slightly larger pool of net income by a significantly larger pool of shares.
Precisely. It is just a mathematical drag.
Right.
The absolute dollar growth of the new high-margin asset is being completely swallowed by the immediate dilution of dividing those profits by an extra 7 million shares.
That is so frustrating for a retail investor.
It is, because in the long term, securing the tomato supply chain for Rouse might be a brilliant strategic move.
Sure.
But in the short term, for someone trading on quarterly EPS beats and misses, this accounting reality acts like an anvil on the stock price.
Because Wall Street algorithms don't always pause to appreciate the long-term vertical integration of Italian tomato.
Exactly. They just see a depressed EPS number and they sell.
Okay, which means we need to look beyond the immediate accounting noise and understand what is physically happening in the grocery aisles. What is causing the organic business to struggle so badly?
Well, the transcript makes it clear that we are looking at a tale of two very different shopping experiences.
Right, the aisles.
Yeah. On one side, you have the meals and beverages division, basically, the soup aisle, and on the other, the snacks division.
Let's start with the relative bright spot. Meals and beverages. Management highlighted that the at-home cooking trend is highly resilient.
They did say that.
But reading between the lines, this doesn't mean people are just buying more cans of chicken noodle soup to eat for lunch, does it?
No, not at all. The transcript reveals a very sharp, honestly fascinating distinction between eating soups and cooking soups.
Okay, what's the difference?
In a highly inflationary environment, the consumer's relationship with a can of soup changes. They aren't buying a can of soup as a standalone meal anymore.
What are they doing instead?
They're migrating heavily toward condensed soups.
Yeah.
Your classic cream of mushroom, cream of chicken, cream of celery.
Oh, the base ingredients.
Yeah. Exactly. They are using these cans as an inexpensive binder or a base ingredient for scratch-made family meals. Casseroles, slow cooker recipes, baked chicken dishes.
Right.
The data point management dropped here is staggering. Over 50% of their entire condensed soup portfolio is now used as an ingredient not eaten on its own.
Over 50%?
Yeah.
I mean, that is the ultimate inflation hack for a family.
It really is.
You take a $2 can of condensed soup, You mix it with bulk rice and whatever chicken thighs are on sale at the meat counter, and you suddenly have a hot meal that stretches to feed a family of 4 for 2 days.
Exactly. It makes perfect sense.
Yeah, as the middle-class consumer gets squeezed by inflation, that specific utilitarian part of the Campbell's portfolio is seeing stable volume.
It creates a structural floor for their volume. But what is equally interesting is the other end of the spectrum.
What's happening there?
Well, alongside the utilitarian condensed soups, they're seeing continued growth in their premium ready-to-serve brands.
Like Rouse.
Yes, specifically Rouse Soups and Pacific Foods organic broths. This premium tier represents about 20% of their ready-to-serve portfolio, and it's thriving.
Wow.
But the mainstream ready-to-serve soups, the standard heat and eat Campbell's Chunky or regular home-style cans, those are facing brutal volume declines.
It's a perfect reflection of the barbell economy.
Completely.
The high-income consumer buying the $6 jar of Rouse soup still has disposable income. They aren't changing their habits.
Right, they don't feel the pinch as much.
But the lower-income consumer, or the squeezed middle-class consumer, is abandoning the middle-tier $3 heat-and-eat soup and trading all the way down to the $2 condensed soup to cook from scratch.
The middle of the aisle is just dying.
It really is. But before anyone rushes out to buy the stock thinking the meals and beverages division is a safe haven, we have to talk about the ERP lab going from Q3 to Q4.
Oh, we absolutely do.
Because this data point completely distorts the reality of their growth.
The ERP lab is, frankly, the most critical piece of forensic accounting in this entire transcript. If an investor misses this, they will completely misread Campbell's next quarter.
Let's break this down mechanically. Because in Q3, management stated that the meals and beverages division took a $30 million hit.
$30 million.
Yeah, due to a Sovos ERP system conversion.
Yeah.
And because they lapped that specific one-time hit in Q4, the division's going to look artificially stronger next quarter.
Exactly.
Now, I understand that ERP stands for Enterprise Resource Planning, and it's basically the back office software that runs the company.
Right.
But as an investor, hearing that a software update vaporized $30 million of top-line revenue, that is infuriating. How does a computer glitch physically prevent cans of soup from being sold?
Well, to understand the magnitude of a $30 million hit, we have to look at the sheer physical complexity of the order-to-cash cycle in a modern CPG company.
Okay.
An ERP system isn't just accounting software. It is the central nervous system that connects everything. The raw tomato suppliers, the glass jar manufacturers, the factory floor robotics, the warehouse logistics, and the electronic data interchange the EDI with retailers like Kroger and Walmart.
Right.
When a company attempts to migrate to a new system, like this Sovos implementation, they're essentially trying to perform a brain transplant while the patient is sprinting on a treadmill.
And clearly the patient tripped.
Hard.
So what actually breaks in that scenario? Give me a physical example.
Sure. Let's trace a hypothetical pallet of Rouse pasta sauce. A grocery chain sends an automated electronic order for 10 pallets.
Okay.
The new ERP system receives it, but due to a mapping error in the database, it fails to allocate the inventory.
Oh.
Yeah. The warehouse forklift driver screen never populates with the task to pick those pallets. The third-party logistics truck backs up to the dock in Texas, waits 2 hours, and leaves empty because the system says there is no load.
Wow. Meanwhile, the grocery chain's automated system expects that truck at their Ohio distribution center by Tuesday at 2:00 p.m. And when it doesn't show up, the retailer doesn't just say, oh, I'll try again tomorrow.
Exactly the opposite. Modern retailers operate on incredibly strict OTIF guidelines.
On time and full.
Right. If Campbell's misses that delivery window because their software didn't load the truck, the retailer fines them aggressively.
Ouch.
Furthermore, the product doesn't make it to the store shelves in time for the weekend circular promotion.
Right. So the consumer walks in, sees an empty shelf, and buys a competitor's brand.
Exactly. That order is canceled, the revenue is lost permanently, and the fines stack up. That systemic friction across their entire network is how $30 million of real physical sales evaporate into the ether of a software glitch.
It is wild.
We saw this exact same disaster happen to Hershey back in 1999 when an ERP failure crippled their Halloween candy shipments. It is a massive operational failure.
Which means when they report Q4 earnings, and the system is allegedly functioning normally again, the meals and beverages division is going to show a $30 million sequential rebound.
Yep. And management is going to point to that and call it growth.
But for the retail investor listening right now, you have to mentally strip that $30 million out.
You have to.
It's a mirage. It's just the absence of a self-inflicted wound. It is not organic consumer demand.
No, it's just the baseline normalizing. The true underlying demand is exactly what we discussed. Strength in the cheap ingredient soups, strength in the ultra-premium rouse, and a massive bleeding hole in the mainstream middle.
Right. And if the soup aisle is a mixed bag heavily distorted by software failures, the snacks aisle is, well, it's a 5-alarm fire.
It really is.
Management noted that multi-packs of Goldfish are up 6%, which makes sense. I mean, those multi-packs are the undisputed heavyweight champion of school lunches.
Oh, absolutely.
But outside of Goldfish, the rest of the bakery and salty snacks division is falling apart.
It's in bad shape.
The transcript contains an admission that is genuinely stunning for a company of this size. They literally had to cancel all promotions in Q3 just to fix on-shelf availability for bakery items.
It is a devastating admission. Canceling promotions in the consumer packaged goods industry is the absolute last resort.
It's basically financial triage.
Exactly.
Let's unpack the gravity of that. When a company like Campbell's cancels promotions, it means they're actively pulling their trade spend.
Right.
They're calling up their grocery partners and saying, take down the sale signs, pull us out of the weekly circulars, stop telling people to buy our bread and buns.
Yeah, they are purposefully suppressing consumer demand.
Why? Because their supply chain was so broken that if a customer actually wanted to buy the product, it wouldn't be on the shelf.
You have to view this through the lens of retail broker relationships, too.
Okay, how so?
Grocery stores map out their promotional calendars months in advance.
Right.
If a retailer allocates premium end cap space for a buy one, get one free promotion on Pepperidge Farm buns for Memorial Day weekend, they expect a massive surge in volume that drives the foot traffic into their store. If Campbell's factories cannot produce the buns fast enough, or their logistics network cannot deliver them, the shelves sit empty.
And the retailer is furious.
Livid. Because they wasted premium real estate, the consumer is alienated and the brand equity takes a massive hit.
So management realized that running a promotion while their supply chain was failing was akin to paying for advertising to highlight their own incompetence.
Exactly. It makes them look terrible.
So they sacrificed millions in short-term top-line revenue because nobody buys premium bakery items on impulse at full price without a promotion just to give their factories a chance to catch up and restock the baseline inventory.
Right. They had to reset.
That explains the violent drop in volume. But the more pressing question is, how do they fix the underlying profitability of these factories moving forward?
Well, the transcript was heavily focused on two strategies.
Okay, what are they?
SKU rationalization and fixing trade ROIs.
Okay, let's translate this Wall Street operations jargon into the physical reality of a manufacturing plant. Why is SKU rationalization the magic bullet here?
So, SKU stands for stock keeping unit. It is the unique barcode assigned to every single variation of a product.
Right, like a family-sized bag of plain potato chips is one SKU.
Exactly. And a single-serve bag of jalapeno cheddar lime potato chips is a different SKU.
Got it.
Management stated they are aggressively cutting the tail of SKUs, meaning they are ruthlessly discontinuing the low-volume, highly complex, niche flavors that only a small fraction of consumers actually buy.
But wait, if a niche flavor still makes money, why cut it? Doesn't a broader variety capture more shelf space?
You'd think so, but it comes down to the physics of factory changeovers. This is where that 400 basis point margin drop originated.
Really? How?
Let's look at a salty snacks manufacturing line. When a massive industrial fryer and seasoning drum is running plain potato chips, it can run 24 hours a day, 7 days a week, at maximum velocity.
Okay.
The unit economics are beautiful, but the moment the schedule dictates a shift to jalapeno cheddar lime, the entire line must be altered.
Right, because you can't just dump jalapeno powder into the drum right after the plain chips.
Exactly. The line must be stopped, locked out, and meticulously cleaned.
Wow.
And if the new flavor contains a dairy allergen like cheddar, the sanitation protocols are legally mandated and incredibly rigorous to prevent cross-contamination.
That sounds time-consuming.
It is. You have to change the packaging film rolls, recalibrate the weighing scales, prime the seasoning blisters. That changeover might take 4 to 6 hours.
And during those 6 hours, the factory is producing absolutely zero revenue.
Zero.
But the expenses don't stop. You are still paying the hourly wages of the sanitation crew. You're still burning massive amounts of electricity and water. And you're still eating the depreciation on multi-million-dollar equipment that is just sitting idle.
Exactly. It destroys the fixed cost absorption of the plant.
That makes a lot of sense.
Furthermore, from a retailer's perspective, grocers hate slow-moving SKUs. Grocery stores operate on razor-thin margins and rely entirely on inventory velocity.
Right, they need things to move.
A bag of weirdly flavored chips sitting on the shelf for 3 weeks is taking up real estate that could be holding a bag of plain chips that turns over every 3 days.
So by eliminating the niche products, Campbell's drastically reduces their factory downtime, improves their fixed cost absorption, and gives the retailer better velocity on the core items.
Yes, it is classic addition by subtraction.
So they are simplifying the manufacturing floor to stop the bleeding. But what about the other side of the equation, the demand side?
Right, the trade ROIs.
Management talked extensively about fixing trade ROIs and explicitly stated they're walking away from TPRs.
Yep.
For the listener, the TPR is a temporary price reduction. This is the classic little yellow tag you see hanging on the shelf in aisle 4 that says, was $4.99, now $3.09.
Right.
Why is Campbell's abandoning the most basic promotional tool in the grocery industry?
Because their internal data revealed that the return on investment for that specific trade spend is abysmal. Yeah. Trade spend is the massive bucket of money a CPG company pays to retailers to secure promotions. When Campbell's funds a basic TPR, they are subsidizing a $1 discount, but the product physically remains in its normal stagnant home location in the middle of the aisle.
The shopper has to actively go looking for it.
Exactly. And the analytics show that the vast majority of consumers who buy a product on a simple TPR were already planning to buy that product anyway.
Oh, so Campbell's is just giving away $1 of margin to a loyal customer without actually acquiring any new volume or stealing market share from a competitor.
Right, that's a terrible use of capital.
It is entirely dilutive to their margins.
So management is aggressively pivoting. They are taking that same pool of trade spend money, walking away from the passive yellow shelf tags, and demanding high-return feature and display placements from the grocery stores.
Okay, we need to define the mechanics of feature and display because it changes the entire psychology of the shopper.
It really does. Feature and display is interruptive merchandising.
What does that mean in the store?
It is when you walk into the front doors of a grocery store the week before the Super Bowl, and you are immediately confronted by a massive custom-built cardboard end cap display featuring Campbell's chunky soup and Goldfish crackers.
Oh, right.
It forces the product out of the dead zone of the middle aisle and places it in the highest traffic perimeter zones of the store.
It bypasses the shopping list entirely. Even if I didn't come to the store for soup, I literally have to walk around the display to get to the produce section.
Exactly. It triggers a psychological impulse buy.
Wow.
The velocity data on an off-aisle display is exponentially higher than a mid-aisle TPR.
Even though it costs more to set up.
Yes. Campbell's has to pay the retailer a massive slotting fee or performance fund to secure that front-of-store real estate. But the volume lift is so violent that the return on investment easily justifies the trade spend.
That makes sense. They're transitioning from passive discounting to aggressive, interruptive merchandising.
It's a necessary strategy pivot, but, it requires flawless supply chain execution.
Which, as we just discussed with the canceled bakery promotions, they do not currently have.
Exactly.
Which leads us to the most terrifying part of this entire earnings call.
To guidance.
Yeah. If a company is actively bleeding 400 basis points of margin, failing to stock shelves, and undergoing a massive operational pivot, the immediate instinct of an investor is to look at the forward guidance. You want to see if management believes the bleeding will stop next year.
Right.
But when you look at their FY27 guidance, management isn't projecting a sunny turnaround. They are bracing for a massive macroeconomic storm.
The guidance data they provided for fiscal year 2027 is incredibly sobering.
It really is.
It perfectly illustrates how fully exposed a domestic food manufacturer is to the chaos of global geopolitics.
Let's look at the specific inflation numbers they provided. Because initially, going into the planning phase for FY27, Campbell's management expected a base inflation rate of around 3%.
Which is pretty standard.
Right. 3% is annoying, but it's manageable. A company of Campbell's size, with a multi-billion-dollar revenue base, has the internal productivity tools, the procurement leverage, and the continuous improvement programs to offset a 3% headwind without destroying their bottom line.
Normally, yes.
However, the transcript reveals that this baseline has been completely shattered.
It has.
Due to the ongoing geopolitical conflict in the Middle East, management now expects an incremental 2 to 3% of inflation layered on top of that base.
That's a huge jump.
It is. They are guiding to a staggering total FY27 inflation rate of 5 to 6% across their entire cost of goods sold.
And this requires a deep dive into the underlying mechanisms of the global commodity markets.
Right, because the immediate question a retail investor asks is, how does a localized conflict in the Middle East directly destroy the profit margin of a bag of Pepperidge Farm cookies manufactured in Ohio?
The primary transmission mechanism, the undisputed variable that connects those 2 points, is crude oil.
Oh,
Management explicitly noted on the call that if global oil prices remain sustained around the $100 a barrel mark, their internal financial models break down rapidly.
but it's crucial to understand that oil isn't just about the fuel cost of the corporate jet or the delivery trucks.
No, not at all.
In the CPG industry, petroleum touches literally every single node of the supply chain.
It is the foundational cost block of everything they do. Let's trace the physical impact of a $100 barrel of oil.
Let's do it.
First, you have the agricultural inputs. Elevated crude oil directly impacts the price of natural gas, which is the primary feedstock for producing the nitrogen-based fertilizers.
Which are used by the farmers who grow the wheat for their bakery division and the tomatoes for their soups.
Exactly. When fertilizer costs spike, crop yields become more expensive and the spot price of agricultural commodities surges.
That's step one.
Second, you have the packaging. The plastic film used to seal a bag of Goldfish, the inner linings of their soup cans, the shrink wrap used to bind pallets together. These are all derived from petrochemicals like ethylene. When crude spikes, the cost of their packaging materials skyrockets almost instantly.
And then, even if you manage to procure the expensive wheat and wrap it in the expensive plastic, you still have the physics of moving millions of tons of heavy liquids and dense carbohydrates across the continent.
The logistics network.
Right.
Freight costs are intrinsically linked to the price of diesel fuel. When diesel is elevated, the third-party trucking companies that haul Campbell's products from a manufacturing plant in Texas to a distribution center in Chicago implement massive fuel surcharges.
That makes sense.
Rail freight rates increase. Ocean freight rates for imported specialty ingredients explode.
It's just compounding.
Exactly. The inflationary pressure of oil hits them in the field, in the factory, and on the highway.
And oil wasn't the only commodity they flagged. They specifically called out severe disruptions and cost spikes in aluminum, too.
Which obviously targets the heart of their business.
Right. The millions of aluminum and steel cans they produce for their condensed and ready-to-serve soups. When you combine agricultural inflation, packaging inflation, and freight inflation, you arrive at that terrifying 5-6% number.
But the external commodities are only half the battle.
Wait, there's more.
Yeah, the transcript also revealed severe structural labor headwinds internally.
Oh, right. They cited a $40 million impact to next year's budget, stemming entirely from an incentive compensation reset.
Yeah, let's translate that.
What does that actually mean?
That means they missed their internal performance targets so badly this year that their employee bonuses zeroed out.
Ouch.
But in a highly competitive corporate labor market, you can't pay your staff zero bonus 2 years in a row without suffering massive turnover and losing your best talent.
People will just leave.
Exactly. So they have to artificially reset the baseline and inject $40 million of guaranteed compensation back into the system just to retain their workforce.
Wow. It's a deadweight cost that produces zero incremental revenue.
Furthermore, the operational labor market is completely stacked against them. They explicitly called out driver shortages as a critical headwind.
Like truck drivers.
Yes, the demographics of the commercial trucking industry are terrible. The workforce is aging out, and obtaining a commercial driver's license, a CDL, is becoming more expensive.
Right.
Even if Campbell's can afford the inflated diesel fuel, they are being forced to pay massive premium rates to the logistics carriers simply to secure a human being to sit behind the wheel of the truck.
And the margins are so incredibly tight, the operating leverage is so compromised right now that even a rare piece of unequivocally good news is immediately neutralized by these labor and FERC costs.
It really is, like the tariff refund.
Exactly. For example, management proudly noted they anticipate a Q4 tariff refund of about 3 to 4 cents per share.
Which sounds great.
Historically, a tariff refund is a beautiful, unexpected windfall that flows directly to the bottom line and delights investors. But management had to immediately walk that back and admit that the entire value of this refund is being completely wiped out by the elevated fuel costs and the driver shortages.
The good news is consumed by the structural bad news before the investor ever sees a dime of it.
So you are staring down the barrel of 5 to 6% inflation across your entire supply chain, compounded by internal labor resets and failing logistics.
It's grim.
The obvious question for management is, how on earth do you defend against that? What is the mitigation plan?
Because they outlined one on the call, but it reads like a company bracing for a severe impact rather than one plotting a growth trajectory.
The defense plan is aggressive because they have their backs against the wall. First, they're executing $100 million in SG&A cuts.
Right. And for our listeners, SG&A stands for Selling, General, and Administrative Expenses.
So this is not the cost of the tomatoes or the aluminum cans.
No, this is the cost of the corporate office. It's the salaries of the executives, the marketing budgets, the IT department, the HR staff.
They were rolling out early retirement packages and voluntary separation agreements.
They are desperately trying to shrink their corporate headcount to permanently lower their run rate expenses.
The strategy here is sheer survival. They have to pull forward as much of that $100 million in savings into FY27 as physically possible.
Right, to act as a financial sandbag against the incoming 5 to 6% inflationary wave.
But you can't cut your way to sustainable growth. You can fire middle managers to protect the margin for a quarter or two, but eventually you hit bone.
You do.
The simplest, most basic way for a company to combat inflation is to raise the price of their product. If your costs go up 6%, why not just increase the wholesale price of a can of soup by 6% and force the grocery store to pass it on to the consumer?
Because the consumer is completely exhausted and management knows it.
They did say that.
They were incredibly explicit on the call, stating that taking further price increases is an absolute last resort.
Wow. Last resort.
Yeah. They understand the concept of price elasticity of demand in the middle aisles of the grocery store. Over the last 3 years of post-pandemic inflation, they have already pushed price increases through the system.
Right.
The consumer absorbed the first wave, grumbled about the second wave, and is now actively rebelling against the third.
So if they push the price of a bag of branded pretzels or a can of soup any higher, the volume won't just dip, it will collapse.
Exactly. The middle-class consumer will walk away from the Campbell's brand entirely and permanently switch to the private label.
The store brand generic version, your Kirkland signature, your great value.
Yep. And once a consumer realizes the store brand is perfectly adequate and saves them $1, it is incredibly expensive and difficult for Campbell's to win that customer back.
So they are caught in a brutal vice. Their input costs are rising by 6%, but their pricing power is completely paralyzed by consumer exhaustion.
Which brings us to the most fascinating and arguably the most structurally concerning part of their entire financial strategy: capital allocation and this complex concept of hybrid debt.
Right, the debt.
When a company's operational margins are compressing and they can't raise prices, the stress immediately transfers to the balance sheet.
Management stated unequivocally on the call that their absolute number one financial priority, and imperative above all else, is maintaining their investment-grade credit rating.
Yes.
They want to get their leverage down to the low threes, meaning their total debt is roughly 3 times their earnings before interest, taxes, depreciation, and amortization.
Right, EBITDA.
To accomplish this while under massive margin pressure, they announced they are considering issuing hybrid debt. We need to dissect the mechanics of hybrid debt because it reveals exactly how desperate they are to protect that rating.
Let's establish the stakes first.
Right.
Why is maintaining an investment-grade rating an absolute matter of life and death for a company like this?
It comes down to the cost of capital.
Exactly. Credit rating agencies like Moody's and Standard & Poor's grade corporate debt. If you are investment grade, your debt is considered safe.
Which means institutional investors, pension funds, and massive bond ETFs are legally allowed to buy your bonds.
Right. The interest rates you pay are relatively low, but if your leverage ratio creeps too high and your earnings drop, the agencies will downgrade you to high yield status.
Colloquially known as junk status.
Yes, and falling into junk status triggers a death spiral.
Let's talk about why. Because many institutional funds have strict covenants that legally force them to immediately sell any bonds that fall below investment grade.
That's the kicker. This triggers a massive sell-off, the price of the bonds collapses, and the yield skyrockets.
So suddenly the next time Campbell's needs to borrow money to build a factory or refinance old debt, the interest rate they are charged by the market explodes.
Exactly. In a low-margin business, a massive spike in interest expense will completely consume their free cash flow. It threatens their ability to pay their dividend or even maintain daily operations.
So maintaining the investment grade rating is completely non-negotiable.
It is. So, enter the solution. Hybrid debt.
Okay. If they issue traditional debt, regular corporate bonds, to raise the cash they need, the rating agencies will look at their balance sheet, see the higher debt load relative to their shrinking earnings, and potentially trigger the downgrade they are terrified of.
Right.
So how does hybrid debt magically solve this math problem?
Well, hybrid debt is a highly engineered financial instrument that sits in the gray area between traditional borrowed money debt and equity, which is stock.
Okay, so it's a mix.
Right. The rating agencies look at the specific, complex terms of a hybrid debt instrument. Usually, these instruments have extraordinarily long maturity dates, sometimes 50 or 60 years.
Wow.
Or they contain specific clauses that allow the company to legally defer interest payments for years in the event of a severe financial emergency without triggering an official default.
That's very flexible.
Because of these flexible equity-like characteristics, the rating agencies grant the instrument what is called equity credit. Often, Moody's or S&P will treat 50% of the hybrid debt as if it were actual equity rather than debt on the balance sheet.
Oh, so by issuing $1 billion of hybrid debt, the rating agencies only count $500 million of it against their leverage ratio.
Exactly. It magically makes their debt-to-income ratio look vastly healthier on paper, protecting that sacred investment grade rating.
But as anyone who follows finance knows, there is no free lunch on Wall Street. What is the catch?
The catch is the interest rate. Because hybrid debt is structurally subordinated, meaning if the company goes bankrupt, the hybrid debt holders get paid back last.
Making it much riskier for the investor who buys it.
Right, so the company has to offer a significantly higher yield to entice anyone to purchase it. Typically, hybrid debt carries an interest rate that is 150 to 200 basis points higher than traditional senior debt.
Okay, let me make sure I have this analogy perfectly mapped to the real world, because this is the crux of the bear thesis.
Go for it.
Issuing hybrid debt to protect your corporate credit rating is essentially exactly like a consumer who has racked up far too much credit card debt.
Okay.
That consumer wants to buy a house, but their debt-to-income ratio is too high. The mortgage underwriter is going to reject the loan.
Right.
So to make their ratio look better to the bank, they go out and take a massive high-interest personal loan from a shady online lender. They use that high-interest cash to pay down the visible credit cards.
Oh, I see where you're going.
Now, technically, under the specific rigid rules of the mortgage application, their ratio looks clean and they qualify for the house. But the reality is they are secretly saddled with a massive high-interest anchor that is going to ruthlessly bleed their monthly cash flow dry for years.
That is a phenomenal translation of the mechanics. That's exactly it.
Right.
The hybrid debt protects the macro appearance of stability. It secures the mortgage approval. It saves the investment grade rating. But it acts as a silent, persistent parasite on the actual profitability of the company.
Because of that extra interest.
Yeah. That extra 150 to 200 basis points in interest expense is a real cash outflow. It flows directly out of the bottom line, meaning it represents a permanent drag on earnings per share for years to come.
So management is willingly choosing to degrade their long-term earnings power just to protect the optics of their balance sheet today.
It is a highly defensive, incredibly restrictive financial maneuver.
Which brings us to the absolute core of our Talk Tickers mission here today.
The bottom line.
Synthesizing all of this data, all of these operational failures, and all of these defensive accounting maneuvers into an actionable verdict for you, the retail investor.
Exactly.
We have analyzed the headline numbers, and we know they are fundamentally weak, masked only by sequential comparisons.
We've looked at the operational story, which involves a massive ERP software failure in the soup division and the terrifying admission of canceled promotions in the bakery division just to keep the shelves stocked.
We've stared into the abyss of the 5 to 6% macroeconomic inflation guidance for FY27, driven by Middle Eastern geopolitics and oil.
And we've seen management resorting to the expensive band-aid of hybrid debt just to keep the rating agencies at bay.
So, what do you, the retail investor listening to this deep dive, actually do with this stock?
Well, if you are looking at Campbell's company right now, the only logical verdict based on this transcript is undeniably bearish in the short to medium term.
Bearish. Let's synthesize the why to make this crystal clear and actionable.
Okay.
For retail investors looking at this company, the reality is stark and unforgiving. Campbell's is no longer playing offense. They are playing pure, unadulterated defense.
They are.
They are facing a tidal wave of supply chain inflation in a consumer environment where they are absolutely terrified to raise prices for fear of destroying whatever volume they have left.
Furthermore, they have explicitly stated that mergers and acquisitions are off the table.
No M&A.
Right. They are not going to be able to buy their way into growth or acquire new high-margin brands to offset the organic declines because their balance sheets simply cannot handle the additional debt.
And crucially, for the income-focused investors who traditionally flock to consumer staple stocks, they are not increasing the dividend.
No. Management was very clear on that. They have no intention of raising the dividend payout anytime soon.
Every spare dollar of free cash flow is being violently diverted to plugging the operational holes in the ship, funding early retirement severance packages, and desperately trying to wrestle their debt leverage down.
Exactly.
So here is the actionable advice for your portfolio. If you currently hold the stock, you need to look in the mirror and understand that you are holding it purely for a frozen dividend yield.
That's the reality.
You are collecting that quarterly payout, and you are hoping, praying, really, that their $100 million in SG&A corporate cost cuts, combined with the messy factory efficiencies of SKU rationalization, somehow magically outpace a massive macroeconomic inflation wave driven by global oil prices.
It's a tough spot to be in.
You are playing a very precarious waiting game where the upside is capped by their balance sheet and the downside is exposed to global commodities.
And if you don't hold the stock, but you are looking at the ticker symbol, seeing the price dip, and thinking this might be a classic value play,
do not touch it. There is absolutely no rush to catch this falling knife.
definitely not.
The turnaround required in their salty snacks and bakery division is immense. Fixing the underlying supply chain plumbing, executing the complex factory changeovers for SKU rationalization, and transitioning the entire grocery retail ecosystem from passive TBRs to interruptive feature displays that is an agonizing multi-quarter process.
It's going to take a long time.
It is not going to be fixed by the next earnings call. And the brutal inflation headwinds, driven by energy markets and geopolitics, are already mathematically baked into the margins for the first half of FY27.
The downside risk remains high, and the potential upside catalysts are entirely dependent on macroeconomic forces like the Middle East cooling off and oil dropping to $70 a barrel, which are completely outside of management's control.
It is the definition of a value trap. It is a legacy company in painful transition, battling a hostile inflationary environment with one hand tied behind its back by its own bloated balance sheet.
That sums it up perfectly.
Which brings us to the end of today's deep dive. We want to thank you for joining us as we rip apart the transcript, cut through the accounting gymnastics, and translate the Wall Street jargon to bring you the raw reality of the situation.
We hope this level of detail helps you navigate your own portfolio with a bit more clarity and confidence.
But before we officially sign off, we want to leave you with one final provocative thought.
Just one final thread to pull on. One macro concept that builds on everything we've discussed today and something you can actually observe in your daily life.
What should they be watching for?
Well, we spent a significant amount of time discussing the sociological shift in the meals and beverages division, how the squeezed consumer is returning to scratch cooking, abandoning the middle tier heat and eat soups, and using basic condensed soups like cream of mushroom to stretch their grocery budgets and feed their families.
Right, the ultimate pragmatic inflation hack.
Exactly. But here is the critical variable you need to monitor over the next 6 months. If the broader U.S. economy enters a true textbook recession and unemployment begins to significantly tick up, this specific trade-down effect into basic, utilitarian, at-home cooking ingredients is going to accelerate massively.
That makes sense.
The question is, does that desperate surge in volume for their most basic, lowest cost products eventually become large enough to mathematically outweigh the massive 5 to 6% supply chain inflation they are fighting on the back end?
Wow. It is a fascinating collision of forces. It's a classic battle of micro-level consumer survival behavior versus macro-level supply chain physics.
Will millions of families trying to save $3 on dinner by making a casserole be enough to save Campbell's corporate margins from $100 a barrel crude oil?
That's the billion-dollar question. Keep a close eye on your local grocery store. Look to see if those massive feature and display setups start appearing at the front doors.
And more importantly, look to see what products your neighbors actually have in their carts when you are waiting in the checkout line.
The answer to whether Campbell's survives this specific macroeconomic storm isn't just hidden in a discounted cash flow model on Wall Street.
No, it is happening right in front of you in real time in aisle 4.
So the next time you go to the store to bake that family cake and you're standing there recalculating the cost of the butter and the eggs, deciding if it's worth it, just remember, the executives running the biggest food companies in the world are doing the exact same panic math, just with a few extra zeros on the spreadsheet.
That's right.
Thanks for listening to Talk Tickers. Keep your portfolio defensive, and we will see you on the next deep dive.